Hi, welcome to today's video and thanks for tuning in. Today we're going to talk about how to get $100,000 per year tax-free income just like this couple. Let's dig into what this actually means. This concept I'm going to share with you can provide cash flow in retirement, most importantly, without subjecting your retirement savings to the volatility of the markets. This is really key here. The way that your cash grows in this investment, it doesn't go up and down with the markets. The way the markets have been so crazy. Look at the markets right now. This is year to date, Toronto stock market down 7%. Ugly, ugly, ugly. It hasn't been too favorable this year, and so that's why this strategy is very popular. If you're new to this channel, hi everybody, my name is David Aaron. I'm an active advisor working with clients right across Canada, business owners, individuals, and families. I do full financial planning, which means I do their financial plans, I invest their money, I do life insurance, I work with business owners, so I'll do group plans, all kinds of things. Head on over to my YouTube channel. I'm nearing 100 videos right now on a number of different subjects that I know you're gonna love. It's easy to understand, straightforward information. So if you haven't subscribed already, hit that subscribe button. Let's get into why you're here today. Okay, I'm gonna introduce you to Sarah and Robert. Sarah and Robert right now are 65 years of age, and they have been receiving $100,000 per year tax-free for life starting at age 65. Now, they started saving in this strategy from age 50, okay, and only saved for 10 years. And the tax-free income that they're currently enjoying does not affect any of their government benefits. So old age security, there's no clawback on their old age security because, again, it's $100,000 of tax-free income. Now, how did they get there? Let's look at how Robert and Sarah arrived at this point. So from ages 50 to 60, they deposited $100,000 per year into a participating life insurance policy. Now, don't get hung up on the $100,000. There are people that do $1 million a year, $250,000 a year, $50,000 a year. Whatever your number is, just divide it by 10 and you're going to get a similar result. But nonetheless, let's go with this example, okay? $100,000 per year into participating life insurance policy, not a universal life insurance policy. This is participating life insurance. And they're depositing only for 10 years, so from age 50 to 60. So the total amount of money they're depositing in that 10-year period is $1 million. Now, from ages 65 to 95, they're going to use the cash value that they have in their life insurance as collateral for a loan from the bank. So every bank does this, even the insurance companies provide the loans. They're going to borrow $100 per year from the bank or from an insurance company, and they're going to capitalize their loan interest. What does that mean? They don't want to make any payments on their loan. They just want the interest to compound, stay inside the loan. They don't want to take any of that $100,000 and use it to pay the loan back. They just simply want to take the $100,000. Now, loans are not taxable. You ever take a line of credit from your home, right, and use that to finish your basement or buy an investment property? None of that is considered income. Same as here is true. The cash value in their life insurance is pledged as collateral, and they take loans that is, and this is all factored into how much they can take, but in this case, we're showing $100,000 per year for that 30-year period, okay? So from age 65 to 95, they're going to take $3 million in cash, tax-free, over a 30-year period. It's a remarkable amount of money. And now, they only used $1 million of their own money to receive $3 million tax-free in their hands. They use it any way they like. If they invest the money into something, it could be tax deductible, that loan, but nonetheless, I'm not going to digress and go into that. They get $3 million tax-free over that 30-year period. And when they pass away, the death benefit pays off the existing loan, and $1.5 million will go to their kids or their charities, whoever they've designated as a beneficiary. Now, if you were to compare, people say, well, I'm not going to use life insurance. Let's just look at if you were to use a traditional investment strategy. So if you wanted to have $100,000 annually, that works out to $8,300 per month. Now, $8,300 per month after taxes is really equivalent to $12,770 before taxes. So that works out $12,770, about $153,000 before tax. So if you were to say, well, how much money would you actually need to have as an investment that would produce $153,000 per year? Well, that's easy to calculate. If you had a 4.5% yield on your investment portfolio, you would need almost $3.5 million invested to produce that amount of money before tax. And here's the key though. Robert and Sarah only used $1 million of their money to produce the $100,000. You would have to put aside almost $3.5 million to get the same equivalent amount of money. And that income that you were going to get from that $3.5 million would affect your old age security. That is the power of this strategy. It's a remarkable strategy. If you have any questions, please feel welcome to call me. Get in contact with me. There is so many ways to get in contact with me, but I appreciate you sticking around to see this video. I always say we take care of your wealth management so you can take care of what's most important to you. There is my contact information. Thanks again for tuning in today. I look forward to seeing your comments below. I want to hear about this because a lot of people have questions around it. So put your comments. Remember to hit that like button. Share this video with everybody you think needs to see this because it is the most powerful way for you to have enough money to live on during retirement, tax-free. I love that word, tax-free. Thanks again for tuning in. We'll see you in the next video. Take care.